Hello, welcome to the week. This is Dawn Connors at Mortgage One, and today we're going to be breaking down thoroughly appraisal guarantees and what that means. This is Dawn Connors at Mortgage One. Please like, subscribe, and share out my video to the world if you like it. And if you find that my service and my videos are exceptional, you can hit the bell on the YouTube channel, and that means that you'll get notifications of all my videos that are coming out. So let's get started. What is an appraisal guarantee and how does it help my client who is either selling their home or buying a home? Well, an appraisal guarantee is a commitment to buy a house even if it appraises for less than the agreed upon price. So let's talk about that. Typically, when you buy a house, you might bid $200,000 for a house, for example. And let's say that you believe that you're worried that it's not going to appraise for $200,000 and the sellers are too. Well, what is winning the most bids right now is what is called an appraisal guarantee, where someone says, we will still buy the house even if it appraises for less than the agreed upon price. So even if it appraises for less than $200,000. What happens in a lending situation is a third-party appraiser, somebody that's unbiased to the buyers, sellers, or the loan process, will go out to the property and will assess the value of the property and give what's called a third-party appraisal. Well, in that assessment, if the house appraises for less than the appraisal, then the negotiation typically opens back up and the sellers can agree to take a lower price. The buyers can come up and offer still the same sale price, or they can meet in the middle. Well, when you do an appraisal guarantee, often that takes out any of that renegotiations after the appraisal comes back. So if a house appraises for $170,000, that same house that was worth $200,000, and you did an appraisal guarantee of $30,000, you're saying my client will still buy that house for $170,000. Well, here's the trick. Here's the most interesting thing. Let's say that your client is putting minimal down payment, 3.5% FHA or 5% conventional. They will have to bring the difference of that $30,000 to closing. However, let's give another example. Let's say that your client that was buying the house for $200,000, that you're buying this house and putting 20% down. So your loan amount was going to be $160,000. Well, that means that if the house appraises for $170,000, you can still buy that house with that down payment and with that loan amount at $160,000. Your client doesn't have to bring any more money to the closing, because the minimum down payment requirement for a conventional loan is 5%, not 20%. So 5% of $170,000 is $8,500. So technically speaking, that person can still buy the house and have a loan amount of $168,500 and still purchase that home that appraises for $170,000. What will that mean to the buyer is that they'll incur a higher payment due to what's called private mortgage insurance. They will get an insurance policy that will insure the buyer against default on the loan, because they're borrowing, in essence, approximately 95% of the appraised value. Even though they're putting 20% down, it didn't appraise for $200,000. It's appraising for $170,000. So all they have to do is incur some PMI insurance. So here's the thing, agents and those out there in social media land. If you're putting more than the requirement down payment, you may not have to bring any more money to the closing if the house does not appraise, because you can pick up and purchase for yourself what's called private mortgage insurance, or it's an insurance policy that your lender will really get for you. You don't shop for it yourself, but your lender will get it for you, and it will be part of your payment at closing, allowing you to buy the house with the house appraising short without you having to bring that extra money to closing. So pretty exciting stuff, right? It's exciting and yet nerve-wracking, because you're in essence buying a house for more than the house is valued at currently. And the thought process behind that is values are continuing to rise, so you'll have the upside of that. That's the thought behind that. The other thought is the cost of renting is so exponentially high right now that it serves clients better to own a home, have a lower payment, have a fixed interest rate where they don't have the adjustments of landlord payment adjustments. So that's some of the thought processes, but you should be aware that if you're choosing to buy a house and put in an appraisal guarantee, what you're doing is you're saying, I will buy this house even if it's not valued at the sale price, even if the house is not worth $200,000, I will still buy it for $200,000, even if it's worth $190,000 or $180,000. I am willing to do that because I like the payment, I like the house, I like the school district, I want to be in that house, I want to overpay for the house and guarantee that I am the winning bidder and that I get this house and that I'm the one that's living in it and not bidder number 6. So that is appraisal guarantees in a nutshell and how to understand them and weave through. It doesn't necessarily, once again in closing, it doesn't necessarily mean that you have to bring the difference to closing. If you're putting a lot of money down, you can choose to have some insurance bought for you and pay for the premium in your monthly payment without having to bring more money to closing. And that premium is relatively low. It could be, depending on your credit score, $20 to $80 a month. Thanks for watching. Have a wonderful, wonderful day and reach out with your mortgage questions or needs.